not only to buy a home of your own as early in life as possible, but also to look at buying your second property as an inflation-proof investment and a cozy earning asset before your retirement. Conversations at most get-togethers in Indian homes used to center around how much so-and-so has made in their property investments. Globally, high net worth individuals have been known to multiply their wealth by investing in smart real estate. But a lot has changed today, hasn't it? Real estate cycle in India is down and people are advised that this is only an end-user market, which means only if you want to live in that residential property, it's worth buying. No longer is such real estate a profitable investment proposition, is what we've been hearing at least for the last 24 months or so. So imagine our excitement when we get inboxed with an article from one of the most trusted voices in real estate titled Creating Wealth with Residential Real Estate Investments. And we decided to dissect that on the show with a gentleman who penned this article, Anuj Puri, Chairman and Country Head, JLL India. Anuj, thank you very much for joining us. I mean, when I saw the title, I was so excited. I said, okay, let me see what you've written. So essentially, you believe that wealth can be created even today by buying the right price residential real estate. Explain it to our viewers how.
So it is true, Manisha, that for a long time now, say about 24 months, it appears that real estate, certainly on the residential side, is down and out. And if you were to speak with anyone and say that real estate is a great investment opportunity, I can tell you that they're going to say as well, certainly not. And this is an asset class that they feel is untouchable at this stage. They feel was fraught with speculators, short-term investors, and it is a very dirty asset class. Having said that, it is the world's largest asset class. I mean, it's 3 times the GDP. And India, we know, is not an insular market. It's getting more attracted towards global. There are a lot of institutions coming into the real estate sector into India, and it is going to get professional. So whilst the human memory is looking at the last 24 months, I want to say is look at it over the last 60 months. There has been profits that have been made in this sector, perhaps abnormally, perhaps also wrongly by the speculators and the short-term investors. But equally, if you were to look at the global scenario and as an asset class, you cannot say that this is an asset class that I'm just not going to look at it. Yes, today it is down and under, but perhaps that is where the opportunity is, because that's when you actually start to invest. It is several times the value of gold, it's several times the value of equities, it is several times the value of debt at a global level. And as I said at the beginning, it's 3 times the global GDP. That's the asset values in real estate at a global front. Okay. So I do certainly feel, Manisha, that this is an opportune time to start looking at investment, certainly on the residential side, but there have to be a lot of caveats. And if I can continue, 4 or 5 very quick caveats one will need to look at it to make sure that you are investing properly. It has to be with the right developer. It has to be the right city. It has to be the right location. It has to be on a project where there is financial closure, and it has to be a project which has got full approvals. And that's where an astute investor should start to look at and start to invest.
So, you know, when you say that it has to be at the right location, at the right price point, how do you go out and hunt these deals? Because most of that stock seems to have been taken over. So either investors are sitting on it, so you get it from the resale market, but new projects seem to be coming up more further down where infrastructure isn't that great. So how would you really narrow down on what could be some of the winning markets?
So very good point, Manisha, and very pertinent. So, you know, given the way India infrastructure has expanded, I will not book an apartment where the infrastructure hasn't yet reached. I mean, we've heard all these stories that the bridge is going to come in, the road is going to come in, the train is going to come in, the water supply is going to come in, the drainage is going to come in. But when it is going to come in, nobody knows. So I am not going to stretch that investment opportunity to take on the edge of the city. I would still want it to be in a locality which is well connected, has the social fabric, has the economic fabric close by, and that's where the location that I would take it, rather than say is that this is a futuristic location and let me take an apartment at that location, because that's where it starts to go wrong. Take an apartment, book an apartment, I would say in the primary sales, at a location which is already established, which has the social and the physical infrastructure.
So you're saying no forward punts, avoid forward punts, because infrastructure in India takes just so long. Okay, so I'm going to bring in Sameer here, because he's also been very, very closely in touch with actual buyers there, and also from the show we've got some insight. Sameer, there was a point when we did have people say forecast where the infrastructure is going to go and take a punt there. But I'm not going to delve or basically spend more time here. I'm saying, is there a thumb rule in terms of rental returns that you can get out of a real estate asset? What is it? How do you know it's the right price for any asset in property that you're getting into on the residential side? Should rental yield be the thumb rule?
Manisha, to begin with, first of all, add to what Anuj has said. Very pertinent points were made by Anuj. Just to add two more points, I think what is going to be driving real estate demand and pricing in the residential side going forward are going to be two more points. One is, most important, is the demand supply dynamics. Now, I can give you case studies here where in the last 2.5 years, properties worth 15 crores have touched 30 crores. Case in point, great developer like Anuj said, DLF, right product, Camellias, has gone up 100% in the last 2.5 years in the worst performing markets, precisely because of demand supply dynamics and employment generation opportunities. Now, if you look at just golf course as an example, there are 1 million square feet of commercial real estate that got ready with prime tenants coming in, or whether you look at some luxury real estate assets in Bangalore, luxury real estate which was high priced in certain micro markets has gone up primarily because of these two factors. In addition to what you asked, the pricing points, I think there is enough data now available in the market from many websites, from many brokers and companies such as ours, where you can actually now see how the price movement has happened over the last 2.5, 3 years and what was the price 5 years ago. Now, if you couple that with the demand supply in that region, which is also very easily available, you can easily come to the right price point of any micro market and make a judicious decision, and you are bound to go right if you follow what Anuj just said and add these two more points. There's a tremendous upside still for going forward. Yes, the horizon should be not 1 or 2 years, but you can take it up to 5 years, and you can easily make a 10 to 15% compounded annualized return going forward. Okay,
seems like both of you are in consensus, even with the returns part of it, 15% over the next 3 years is possible. My question to you, Anuj, is in your article, Sameer here mentions a couple of markets, and he's always had the knack of picking these markets where I'm sure he owns a lot of real estate, which have given you phenomenal returns, even being in luxury segment. Your article on the other side says, protect your downside and look at the 2,800 to 5,000 bracket. These are two, absolute opposite ends of the conversation, isn't it?
So it's a very good point, Manisha, and I'll try and explain. But I just want to reiterate one point that Sameer said, and that was the last sentence that he said. Very, very important for those who are seeing your show, Manisha, that this investment is not a short-term investment. It's not a 6, 12 month. As Sameer very rightly put it up, you have to look at a 4, 5, 6 year horizon. Don't think that I'm going to get in and then I'm going to get out in 6 months' time. Also, it is a illiquid asset class. It's not like a stock market. It takes time to monetize the assets. So those viewers who are going to get excited with what Sameer and I are saying, Manisha, we just want to put in that caveat as well, that take the horizon as at least 5 years, not shorter. Sameer is right when he says the premium, but it is also in the segments, Manisha, where there is very less supply of premium. So he picked up the example of Camellias, or he referred to Bangalore. Very conveniently, Sameer did not refer to Mumbai, where I'm sitting in, because this is a place which I can tell you, in premium, you would just not want to touch it.
Yeah, absolutely.
You just don't want to be close to premium unless you are an end user.
Okay, fair enough. So I would like maybe three, thumb rules, because what I gleaned from your article, which was a really interesting point, say map out that it is at least lower than the 2008 level, the property that you're buying, right? So that's a good price point to look at, that it's not overinflated, it's below 2008 levels, and clearly over 5 years, it has more than 5 years, 7 years, it's actually available to you cheaper. Second, Anuj, what most experts tell me is that in India, the reason why real estate was so overinflated and was bound to come down was the rental yields on residential. And they were always very poor, and it was always a capital gains game, which is now ending. So if you are likely to get a 3.5% rental yield on an asset that you're going to buy today, it's probably the right price. Would you go with that? I mean, would you go with that thumb rule?
I would certainly go with that thumb rule, but Manisha, I can tell you it is equally very difficult today to say is on the asset that I'm going to buy today that I'll be able to get 3.5% rental return today itself. So what you will have to look at it is maybe 18-24 months going forward, and expect that at that time you will have between 2.5 to 3.5% rental return coming in from the residential. But buying it at today and then trying to see is whether I can get 3.5% on today's rental may be a little bit difficult. So perhaps you'll have to look a little forward and then make your rental yield expectations.
Okay, final question. Anuj said primary markets ideally, but with a lot of due diligence. Sameer, you've always been saying hit the resale market. There's so much inventory available outside. Between the two, Sameer, which one would you pick today?
Well, I would pick up most definitely the resale market, under construction market, which the investors had actually got into and are looking at exits. Anuj and I are primarily saying really the same thing. Go into the primary markets, but if the developer is not giving you the right price, you may just get the right price from an investor who's stuck over there. But primarily go into the primary under construction markets, not with projects that are just about to start, but projects that are midway through or nearing completion.
Anuj, is that so? Go with under construction project in advanced stages of construction, and primary or resale wherever you get, developer or resale wherever you get the best deal.
And it is true, and the reason for that is, Manisha, there is a little bit more confidence that at least the approvals would have been in place, at least the initial approvals are in place, and the developer has been able to bring the project to a certain level of development. The other addition that I would say is it's perhaps good quality developers, several good quality developers that you have across India, and those for those developers who are just launching the project, I think it is still worth picking it up, because their reputation precedes. If the value at which they are launching is the right, I would pretty much encourage the investors to look at buying with those developers.
Except that I probably can count them on my fingertips, those developers.
Yeah, the problem is they're charging their premiums today because of their brands.
Absolutely. Yes. So sometimes, I mean, I would think that a hidden gem, a smaller investor who's got a great track record and fully funded, like you said, if you can find out the funding. I really think now is the time when developers, rather than coming out with beautiful ads of houses which look really swanky, would just come out with simple information disclosure ads saying, we've got our funding tied up, these are the people who are funding us, we've got all the approvals, these are the approvals in place, and hey, we promise you we'll deliver. We're not saying 3 years, maybe 4 years, but we'll give you a house in 4 years. Those kind of ads might probably generate more transparency and excitement in the market. Anuj Puri, always a pleasure to have you with us. Thank you so much for joining us today.
Thank you very much, Manisha.